Hello, and thank you to today's compliance review of COBRA administration. We will be going through a high-level overview of the Federal COBRA administrative regulations. I will be touching briefly on the agenda here in just a minute. I would like to thank our partners, Angel Peel, Health Insurance Consultant Specialists over at EPIA Insurance Agency for arranging this webinar. I would also like to note that if you have any questions regarding this presentation, you can reach Angel directly at 626-912-1988. Her email address is angel@ppo-hmo.com. That's ANGEL@ppo-hmo.com. So again, a very appreciative thank you to Angel Peel for coordinating this COBRA webinar. We'll be going through here in just a few minutes an overview of COBRA, the administration, the federal impact, and the ACA impact of COBRA. My name is Mark McGinnis. I'm the Director of Compliance here at Ward & Brown, and we are the back-end compliance specialist for Angel Peel and EPI Insurance Services. I wanted to start briefly by talking about what Federal COBRA is. Federal COBRA is a law that was enacted back in 1985, and it's interesting because there's been a lot of questions over the last 2 years about what's going to happen with COBRA now that healthcare is guaranteed issue. I've had several questions about what's going to happen now that COBRA is going away, what's going to happen now that no one's electing COBRA, and I want to dispel those myths today and during our presentation. The first note that I'll make here is that COBRA is not going away. In fact, there's not a single phrase or sentence within healthcare reform that would suggest COBRA is going away or is going to be reenacted on some level or amended on some level legislatively. The second part I'd like to say is that COBRA is complete, or ACA has created a completely new compliance awareness as it relates to COBRA in general. So people are paying more attention to compliance in general, and COBRA is a significant part of that. The last note that I'll make here is that since guaranteed issue healthcare under healthcare reform guidelines, there's been less than a 3% decrease in COBRA elections in the market, and that's extremely low. I thought the number would be much higher in terms of a decrease in COBRA elections. And so what that essentially tells me is that the same people that were electing COBRA before ACA are the same people that are electing COBRA post-ACA. That means the individuals that have always elected COBRA are individuals that have high-cost medical conditions. Maybe they have family members or dependents that are in the middle of some type of significant treatment, and they don't want a disruption in their primary care physician, their doctor, whatever the case may be. They want to continue the coverage that they have under COBRA, and rightfully so. And so it's also worth noting that COBRA is actually more cost-effective than certain exchanges, especially outside of the state of California. So the compliance aspect of COBRA isn't going away. COBRA elections statistics are still holding relatively steady, and COBRA is actually more cost-effective in a lot of areas in this country. So wanted to touch on that before we officially get started. It's also worth noting that you're going to hear a lot of references to ACA and healthcare reform as we work our way through these slides, and the reason for that is the legislation that was written many years ago for COBRA has been borrowed to write much of the ACA regulations. It's federal legislation that is airtight in a lot of areas, and it would make sense that the government's going to use a lot of the language that was written for healthcare legislation under COBRA many years ago. So there's three enforcing agencies or watchdogs, if you will, that govern COBRA, and that's the IRS. They have the authority to issue regulations defining coverage and sanctions. The Department of Labor has the authority to issue regulations pertaining to COBRA's reporting and disclosure requirements. And then you have the Department of Health and Human Services, the authority to issue regulations that require state and local governments to provide continuation coverage. If you have ever been audited, it's likely going to be an audit that was driven by the Department of Labor. The Department of Labor makes it very easy for former employees or even active employees to file an official complaint, which can in many cases lead to a reporting and disclosure request by the Department of Labor, which could very well lead to an audit. So it's very important to make sure that we're aware of who our enforcing agencies are. There are really 3 different ways that an employer can get dinged for non-compliance penalties. The IRS has the authority to issue a $100 per day penalty up to $200 per day per family maximum for every day that the employer is out of compliance, with a maximum annual penalty that cannot exceed $500,000. Now, I've never seen a penalty that has reached $500,000, but I have seen civil lawsuits, which is the last bullet point there, civil lawsuits that have far exceeded that amount. There are so many different ways that an employer can ultimately get themselves into trouble. Statutory penalties, ERISA penalties for noncompliance. Civil lawsuits are probably the most threatening because it's when you've got a former employee that maybe was never offered COBRA that finds themselves in a critical situation where they're hospitalized or they're needing to pay for claims and they were never offered COBRA. Ultimately, the employer could very well be on the hook to have to pay for those types of penalties. So there's 3 ways here: IRS penalties, statutory penalties, and civil lawsuits. And frankly, it's small group employers that really can't afford to get dinged with one of these penalties. So it's important to make sure that we're aware of what the ramifications are for noncompliance. So who is an employer that's subject to COBRA? It's any employer group that has 20 or more full-time equivalents for at least 50% of the typical business days in the prior calendar year. So on January 1st of every year, so we'll use January 1st of 2016 as an example. January 1st of 2016, employers should look back at their 2015 plan year, and if they maintain 20 or more full-time equivalents for at least 50% of the typical business days of the preceding calendar year, then they would be ultimately subject to federal COBRA for all of 2016. Now, it's important to remember that this is not just full-time equivalents. This is going to be part-timers as well. So if you have, let's say, 15 employees or so that only work 15 hours a week, well, each of those employees need to be counted as half of a full-time equivalent. If you have an individual working maybe 8 to 10 hours per week, well, that individual needs to be counted as a fractional or 25% of a full-time equivalent. So when you're making these determinations, remember it's not just your full-time equivalents, your full-time population. It's going to be your fractional employees, your part-time employees that need to be lumped together in this calculation. I've also made a note here for control groups. If you are an employer that is considered a control group and you happen to own multiple subsidiaries, 80% or more common ownership amongst multiple subsidiaries, your divisional subsidiaries need to be factored into the equation. What do I mean by that? I ultimately mean that, let's say I own a 10-life group here in California, and I also commonly own a 15-life group in Nevada. Well, because I own both of these entities collectively, my common ownership or control group scenario has more than 20 employees, and collectively that means that I have more than 20 full-time equivalents. That means that both entities, my 10-life group and my 15-life group in Nevada, under control group rules, would be subject to federal COBRA. So remember, just because you have less than 20 employees doesn't necessarily mean that you wouldn't be subject to federal COBRA in a control group scenario. So that's very important to take note of. Entities that are not subject to federal COBRA, that's going to be employees that have, or employer groups rather, that have less than 20 full-time equivalents. So if you truly have less than 20 full-time equivalents for at least half of the typical working days in the preceding calendar year, then you are truly subject to state COBRA. In this case, it would be California COBRA. So entities that are also exempt, that would be church plans. If you are a church plan and you've never offered COBRA in the past, you are not legally required to offer COBRA. Federal government entities are not required to comply with COBRA as well. The types of plans that are subject to COBRA, I think a lot of the times we're guilty of associating COBRA with medical policies. It's important to remember that dental, vision, prescription drug plans, health FSAs, HRAs, executive reimbursement plans, EAPs, wellness programs, cancer policies, certain alcohol treatment programs are also subject to federal COBRA. These are health plans. If you're offering these types of plans to your employees, but you're not offering the right to continue those plans under COBRA when they've terminated, that could be a potential issue for you. The last bullet point here, COBRA does not apply to HSAs, LTCs, life insurance, or disability insurance policies. That's an important note here. That's not changing anytime soon. So HSAs, LTCs, life insurance, and disability insurance policies are not subject to federal COBRA. If a plan meets the above condition for health FSAs, then they need to be offered COBRA. So if you offer a health FSA, it's important to know that a health FSA is always subject to federal COBRA. But it's also important to note that not every terminated employee that loses their FSA benefit needs to be offered the right to continue their FSA benefit under COBRA. So what needs to happen? There's an underspent and overspent determination that needs to take place. So for example, if I terminate my employment today and I've lost my health FSA, I will have either overspent or underspent my physical contribution at the point of termination. So for example, let's say I've contributed $1,000 into my health FSA, and at the point of termination, I've only utilized $500 of that $1,000 contribution. That means by definition, I've underspent my physical contribution into the plan, and therefore need to be offered the right to continue the benefit under COBRA. In the reverse scenario, if I've overspent my physical contribution into the plan, remember health FSAs have a uniform coverage rule that allow me to access 100% of my election amount day one of the plan year. By definition, if I've overspent my physical contribution under the plan, then I should not be offered the right to continue COBRA. For those of you that sponsor HRAs, and HRA is a health reimbursement arrangement, HRAs are always subject to federal COBRA, regardless of what type of HRA it is. HRAs are always subject to federal COBRA. A qualified beneficiary is an individual that's an employee that's covered. It can be a spouse or a dependent that's covered. It can be a child born to or placed for adoption through the covered entities' COBRA coverage or health insurance coverage. I made a note here to discuss domestic partners' qualified beneficiary rights. I need to make sure that there's a distinct difference between qualified beneficiaries and COBRA eligibility. So for instance, if I lose my group health plan today, and as a result of losing my group health plan today because of a termination, my spouse and dependents also lose coverage, all of us become qualified beneficiaries. This means that my employee, my spouse, and my dependents, they all have individual election rights. I can elect COBRA for just my spouse. I can elect COBRA for just my dependents if I wish to do so because we're all qualified beneficiaries. However, if I had a domestic partner that lost coverage as a result of a termination, my domestic partner could elect COBRA, but my domestic partner could not add a dependent or a future domestic partner to the COBRA coverage because they're not federally recognized as domestic partner. So I may need to make sure we're clear on that, right? Domestic partners are eligible for COBRA, but they're not considered a qualified beneficiary for qualified beneficiary purposes. And a covered employee is any employee or former employee covered under the group health plan, an agent or independent contractor covered under the group health plan, or a corporate director covered by the group health plan. So qualified beneficiaries must be treated the same as similarly situated non-COBRA beneficiaries. I underline open enrollment here because it's important that during your open enrollment process each year, that your Cal COBRA and your federal COBRA beneficiaries are all given the same open enrollment right and opportunities as any active employee. That means if I'm a COBRA participant with your organization, I need to be given the right to move from your HMO plan to your PPO plan, or if you're offering a dental and vision plan that you weren't previously offering before, I can enroll in those plans. If I have a spouse or dependent that hadn't previously been covered on the plan, I can add them during open enrollment. The key here is to make sure that COBRA participants are given the same right and communication opportunities during open enrollment. You want to do that to avoid potential discriminatory issues. So whatever or however you're communicating to your active employees for purposes of open enrollment, you need to be doing the same for your active COBRA participants. What is a qualifying event under COBRA? Qualifying event for an employee can be a termination of employment, and that can be voluntary or involuntary. It can be a reduction in hours. So if an employee went from 30 hours a week to 15 hours per week, which triggered a loss of coverage, that's an employee qualifying event. That's an 18-month qualifying event. There's also a separate category for spouse and dependents only, divorce or legal separation. It can be a loss of a dependent child status. It can be death of an employee or retirement of employee, or it can be an employee's entitlement to Medicare that triggers a loss of coverage under the group health plan. So I like to separate these into two different categories. You have employee qualifying events, and then you have dependent qualifying events. The dependent qualifying events are subject to 36 months of COBRA coverage, and we'll get into the duration of benefits here shortly. I've added a couple of in anticipation rules that I'm not going to spend a whole lot of time here on, but I wanted to touch on two of them. The first is that an employer can never terminate an employee's health coverage in anticipation of a termination of employment. That seems fairly straightforward, but I wanted to make sure we were clear on that. And then there's also a separate rule, which is probably more relevant. An employee can never terminate their spouse from the group health plan in anticipation of a divorce. So it's important to make sure that, an employee that's trying to terminate their spouse from the group health plan in anticipation of a divorce, to actually have a decree of divorce or a specific finalization date or certification that proves to the employer that the divorce is actually finalized. The duration of benefits, we've already briefly touched on this, but I think it's worth going through it again. An employee qualifying event is 18 months. That's for terminations or a reduction in hours. A dependent qualifying event is subject to 36 months. That'd be your death, divorce, legal separation, etc. There's also an 11-month disability extension for those that are deemed disabled at the point of termination. And then you also, as the employer, can choose when coverage begins. So coverage will either begin on the date of the qualifying event or the date the loss of coverage, or the actual loss of coverage date. Here in California, it's typically going to be the loss of coverage date. So for example, if I were to lose my coverage in mid-April, I would be covered on my employer's group health plan until midnight of April 30th. And then if I were to elect COBRA, I would be reinstated back onto my employer's group health plan effective May 1st. The last bullet point here, the coverage can never include some type of gap. So there can never be a gap in coverage. So again, going back to my previous example, if I were to lose coverage in April, I would be covered on the group health plan until midnight of the last day of month of April. And if I were to elect COBRA, I'd be reinstated back onto the group health plan effective May 1st, therefore ensuring that there was no gap in coverage. So let's go ahead and just calculate, or at least resurface on what we just discovered. Multiple qualifying events, dependent qualifying events are subject to 36 months. Those that are deemed disabled at the point of termination or within the first 60 days of termination qualify for an 11-month disability extension. Here in California, in addition to 18 months of federal COBRA, we have Assembly Bill 1401 that would allow an employee to extend their COBRA by an additional 18 months. We don't see that happen too often here anymore, but that would mean that qualifying events here in California would allow for 18 months of federal COBRA coverage coupled with an additional 18 months of COBRA coverage under Assembly Bill 1401, so a grand total of 36 months of coverage. Election rights, so individuals that elect COBRA, their coverage can never differ from that was offered to similarly situated individuals, meaning that if I if I lost my Blue Cross HMO plan today and I terminated, I need to be offered that same Blue Cross HMO plan. The employer cannot offer me a reduction in benefits for myself or my beneficiaries, nor can they require a proof of insurability. My dependents and I that lose coverage all qualify for separate elections under the group health plan. And then lastly, am I allowed to carry COBRA coverage along with a new group health plan simultaneously? The answer to that question is yes. If my COBRA coverage covers something specific or a treatment or a specific drug that my new group health plan does not cover, legally I'm allowed to carry both policies simultaneously. So let's talk about election rights for a few minutes here. Election rights usually start the day that the coverage ends or the date that the COBRA election notice was mailed. So let's say my election notice was mailed on the 1st of the month. That would start a 60-day election window for me. And my beneficiaries and I would have 60 days to decide whether or not we want to elect COBRA. The beneficiaries also have 60 days to notify a plan administrator when there's been a loss of dependent child status, divorce, or legal separation. And we're going to talk about that when we get into general rights here in just a minute. So as it relates to paying for COBRA coverage, it's important to note that Federal COBRA is typically 102% of the applicable premium. California COBRA is typically 110% of the applicable premium. And for those that may have an individual that has elected the disability extension, typically the premium is going to be 150% of the applicable premium. So what is the definition of applicable premium? That's going to be the cost to maintain the plan. So if you're outsourcing your COBRA, chances are you're going to see that 2, 10, and 50% additional administration fees. If you're self-administering, you can choose to decide whether or not you want to add the 2, 10, and 50% as an override on the administration fee that's being billed. Timely payments. So I know that I have 60 days to elect COBRA from the date the notification was mailed. I now have 45 days to make my first premium payment. So I'm going to talk briefly about what that timeline looks like now. So let's recap what we've discussed in terms of the important timelines. For employers that are self-administering, you have 30 days to notify the beneficiary of their qualifying event. If I'm outsourcing my COBRA, I have 30 days to notify my plan administrator, which would be my TPA. And in turn, my TPA has 14 days to send out the COBRA notice. So collectively, you have 44 days to notify the individual that they're eligible for COBRA. Once that individual has been notified of their COBRA rights, that opens up a 60-day window for the individual to elect COBRA. Assuming they elect COBRA, they now have a 45-day window to pay their premium, to come current with their premium that's due. Once they've paid their premium, they now have a 30-day grace period, meaning that, let's say I elected COBRA, and I elected COBRA that was effective in April. That would mean that my April COBRA premium is due at least postmarked prior to midnight of April 30th. Notification requirements. I wanted to spend some time talking about the General Rights Notification Letter. The General Rights Notification Letter, formerly known as the Initial Rights Notice, is frankly the notice that probably gets employers into the most trouble. This is the notice that is required to be sent to an employee, a spouse, or a dependent when they first become covered on the group health plan. I think a lot of times when we think about COBRA, we immediately just assume that it's the notice that you send to an employee when they first become eligible, when they first become eligible for COBRA or they've lost their group health plan. This notice actually is required to be sent to an employee when they first become enrolled on your group health plan. So here's the deal. When to send a COBRA notice? Well, anytime you've added somebody to your group health plan, you need to send this notice. Anytime you add a spouse to an existing employee's group health coverage, you need to send a new notification. Anytime there's a dependent that's added to the group health plan, they need to be notified of their rights. What's the general notice and what's the information that's included? The reason this notification is so important is that it specifically goes into detail regarding an employee, spouse, and dependent's future rights and obligations under the law as it relates to a dependent qualifying event. So for example, if my spouse and I were to be divorced, how would my spouse and I know what we were supposed to do in terms of notifying our plan administrator? Right? If I'm going through a divorce, it's probably not something that I want to be actively talking to my employer about. In this notice, it specifically states that in order for dependent qualifying event COBRA coverage to be offered to my spouse, well, my plan administrator, my employer in this case, needs to be notified that there's been a dependent qualifying event. So in this notice, the employer makes it very clear to the employee, spouse, and dependents of what their future rights and obligations are under the law, meaning that you have to notify the plan administrator if there's been a dependent qualifying event. This is a very important piece to the COBRA administration puzzle. This is essentially the employer's get-out-of-jail-free card if a former spouse of an active employee happens to come back and say, you never offered me COBRA when we were divorced, and now I have claims and I've racked up medical expenses. If the employer can furnish a copy of this notice and prove that the notice was sent, they're going to be in a much better place. So how does this notification need to be distributed? It needs to be distributed using first-class mail or the USPS certificate of mailing. These are truly the only methods of delivery that have held up in court 100% of the time. You probably do not want to insert this notice into a payroll statement or post it on a bulletin board. It's important to make sure that this notice is included with a summary plan description, but it also should be mailed. And the reason it should be mailed is that you always want to put yourself in a position where you can prove that the document was mailed or at least was in the hands of the U.S. Postal Service. If you're not archiving these notices, or you're working with a third-party administrator that's not archiving these notices, then you are potentially at risk of a non-compliance penalty or a potential civil lawsuit if a former employee's spouse or dependent ever happened to come back and suggest that they weren't offered COBRA. Now let's talk about the election notification. This is a notice that needs to be sent to employees when they become eligible, or former employees potentially when they become eligible for COBRA. So you have an employee that's terminated and they need to be offered their right to continue COBRA. These are not suggested items of communication within a qualifying event notice or election notice. These are all required by the federal government. So you talk about the type of qualifying event, the date of qualifying event, the election period, the due date of premium. These are all required items within a COBRA election notice. There's also a conversion notice. Now this is extremely rare these days, but if you have an employee that exhausts all of their 36 months of COBRA coverage, meaning they've been on COBRA for 36 months, it's probably because they are sick and they have a high-cost medical condition. At the end of their 36 months, once they've officially exhausted their COBRA coverage, they can typically qualify for a conversion plan with certain carriers. That means that they would essentially be able to stay on the same type of plan with the carrier directly, rather than going through an exchange or some type of health marketplace. It's important that when you're looking at your billing statements to track to see how long certain COBRA members have been on your billing statement. If you notice that you have an individual that's been on your billing statement for 33, 34 months, it's probably a pretty good indicator that they're going to officially exhaust their COBRA coverage. And it's a good idea to reach out to your health insurance carrier on their behalf to see what types of conversion options are available for that individual so that you can proactively communicate those to the individual that's been on COBRA. There's also a couple of notification requirements that are commonly missed. The notice of early termination. This is when an employee or a COBRA participant decides that they no longer need COBRA. They voluntarily terminate their COBRA coverage. By terminating their COBRA coverage, they need to be notified that their COBRA coverage is no longer available to them. So it's terminated early, and it's no longer available to them. Most COBRA third-party administrators are distributing this notice on behalf of employer groups. If you're self-administering COBRA, this is a notice that you'll definitely need to be sending to those individuals that terminate their COBRA coverage. There's also a notice of unavailability. That's a notice that needs to be sent to an individual that, best example I can give you, let's say you have an individual that moves to Wisconsin and they've terminated employment and they've lost their health coverage and they've in turn moved to Wisconsin. And as a result of that, their coverage that they would have normally elected under COBRA is no longer available to them in the state of Wisconsin because it's outside of that coverage zone. So a notice of unavailability needs to be sent to that individual, letting them know that COBRA is not an option for them. Most COBRA administrators are not going to distribute this notice on behalf of employer groups. So you should either do a Google search to secure a copy of this notice or reach out to your COBRA administrator and ask them for a copy of it. Most of them will have one for you. Employee notification requirements. Remember that employees have 60 days to elect COBRA. They also have to notify their employer within 60 days of a divorce or legal separation or a loss of a dependent child. They also have 60 days to notify Social Security Administration of a disability. And then lastly, 30 days to notify Social Security of final determination that the individual is no longer disabled. So employees have notification requirements too. So as we conclude here, it's important, just a few updates, that on May 2nd of 2014, there were some changes made to the standard COBRA notices that are being used in the market. The first is a state marketplace notification change. So if you are self-administering COBRA and you haven't updated your notices within the last couple of years, the notices that you're using are out of date. If you are using a third-party administrator currently, That's good because they are likely using the most current notices. You can always access notices going to the Department of Labor's website, dol.gov. That's dol.gov, to access copies of the COBRA model notifications. The notices have been completely rewritten. They're much easier to understand now. It's also important to note, especially for groups in the 50-plus market, that 60-55, 60-56 reporting applies to the COBRA population. Audits are more frequent. They are more stringent. And it's not just because the IRS has hired more auditors. It's because there are now mandates for auditing. So employer groups are being required to be audited. It's still a random audit, but they're now required and mandated as opposed to just being randomly selected in the past. So it's important to make sure that you're in compliance in all aspects of healthcare. The last couple of bullet points here, I wanted to remind you that COBRA is still very relevant. There's been a moderate decrease in medical COBRA elections. Non-medical COBRA elections are stable, meaning that people are still electing COBRA for dental and vision and HRAs and FSAs. And the compliance aspect, most importantly, compliance aspect of COBRA is not going away. So if you're thinking that, well, I only have 1 or 2 employees that terminate a year and we don't have anybody on COBRA, well, that's fine. But remember, that doesn't change the fact that you still need to be distributing notices that are compliant, that you need to be distributing them in a compliant fashion, and you need to be archiving them in such a way that you can always provide reference if you are audited or you're ever asked to provide a copy of a specific COBRA notice. So with all of that being said, because you partner with Angel and EPIA Insurance Agency, you do qualify for free COBRA administration through EPIA and the Word and Brown relationship. This is not limited COBRA. This is full contractual federal COBRA. This includes an online reporting system. This includes the distribution of notices, the tracking of all the notices we've discussed in this presentation. Also includes a COBRA administration manual, contractual indemnification, and account management and participant management support team, and then the billing and the remittance of COBRA premiums along with communications to the carriers. So it is a full service, fully outsourced federal COBRA administration service that's available to you through our partners at EPIA Insurance Services. It's also worth noting, by working with Angel, you have access to a free Section 125 premium-only plan. This is a summary plan document that allows your employees to pay for their health insurance contributions on a pre-tax basis. So again, a couple of key value propositions that are very important from a compliance perspective that are available to you through your relationship with EPIA. We also have HR Wow that's available to you at no cost. This is a website and a service that allows you to have live assistance with any of your HR-related questions. If you have a question about your employee handbook, or let's say you don't even have an employee handbook and you need help drafting one, HR Wow has templates that you can use to draft employee handbooks. They have an HR resource library. They have a form and document library. Let's say you're looking for a template on how to recruit new employees, or you're looking for a template on how to terminate an employee. This website has complete access to all of those types of documents, as well as human resource professionals and live assistance, so you can speak with a representative that can walk you through a process or can guide you through any sort of sticky situation that you might be involved in. So again, just another layer of accountability. We also have support for ACA related questions. So we are the back end Affordable Care Act specialists on behalf of EPIA Insurance Services. So any ACA related questions you might have, we're more than happy to assist you in that regard. So please work through Angel Pill and your partners at EPIA Insurance Services. Any questions that you may have, any need for support, work directly through them, and we'd be more than happy to support you in any way possible. Lastly, if you have any questions on any of the material that we discussed today as it relates to COBRA, you can filter those questions again to Angel Pill. Again, her email address is angel, ANGEL, @ppo-hmo.com. Her phone number again is 626-912-1988, and we look forward to working with you. Thanks so much for your time and attention. Take care.